I was alluding to the PMI number that was released here in South Africa, sitting at around 44, down 10 index points for the month of July. How significant is this when it comes to the local currency and movements, given the fact that we're starting to see things looking slightly better from a US perspective, given the fact that there is some kind of resolution on the table with regards to the US debt ceiling?
You know what, I think that the big picture really is that there's a lot of weakness still expected out of the US. You know, the consensus around this US debt ceiling is only really the beginning. We really are concerned around the fact that there very likely is a chance of a massive downgrade, not even just one, potentially even two, because the reality is that two things really happened. They didn't increase the ceiling by what the credit ratings agencies were looking for, which was about $4 trillion, as well as the fact that they're also going to be cutting back in terms of spending in an environment where you really do need to see government spending to help to bolster that economy. So stuck between a rock and a hard place, how that sustainability is going to present itself with regards to repaying that debt and cutting back the spending that they're talking about, I'm not sure that the ratings agencies are going to be that comfortable around that. So I think that the rand strength that you're seeing, the euro strength that you're seeing really is playing through as a dollar weakness signal. Obviously right now waiting for that final vote out of Congress and then waiting to see what the ratings agencies say about that going forward.
Interesting. I mean, final vote out of Congress is what we're looking for today, and of course we know that the deadline is in fact tomorrow. But Brigid, at the end of the day, when you see the spending cuts that are on the table, we're talking about $2.4 trillion over the next 10 years. Some say that isn't significant. Others say that this could actually add more worries to a very troubled economy, and that could of course be evident in some of the economic data that we will be seeing going forward. And in fact, it has been evident in already the numbers, especially on the employment front.
Absolutely, and I think that's what you've got to keep in mind. I mean, any of the money that should have flowed through to the consumer in these all-time low interest rate environments should have already happened, and that hasn't happened. So you've got to facilitate some form of growth. I mean, if you look at the likes of the Japanese economy, post what happened at the tsunami and the earthquake that they saw, their government spending and the government capacity is what's really allowed that economy to continue to grow. And you really do need to see some form of sustainable growth coming out of the United States. It's a big concern that their housing market hasn't come online. It's a concern that the jobs and unemployment remain at elevated levels. We've got the non-farm payrolls out again on Friday, and you know, obviously we're going to be watching clearly what's happening with regards to the US economy. This week we are presented with a lot of data. Today is PMI day, so we've had UK PMI, we've had the Eurozone PMI, specifically out of Italy, France and Germany. All quite elevated levels with regards to the Eurozone. Interestingly enough, all in expansionary territory, all above that 50 level. The UK came in below 50, and then South Africa disappointed at 44. And I think the big driver behind that was the strike action that we saw last month. And there goes to show how negatively the strike action in South Africa does impact that PMI number. And obviously with PMI being such a big contributor to our GDP, it is a massive concern.
Okay, well, Brigid, let's delve further into that PMI number. We're talking around 44 points for the month of July. And again, it's a 2-year low. We're talking about the strike action. Do you think foreigners are taking cognizance of this? Because this still comes at a time where bonds are looking very strong. The inflows into South Africa are well intact and well in play.
Correct, and we're seeing our bond market really hard. I mean, we've got extremely strong levels. In fact, we're at the lows for the year. We're trading currently on the 157 at 726. So there is still good appetite for our bond market. Obviously, our bond yields offer good value, and definitely if you look at the environment offshore where interest rates are at such low levels, you're getting a carry of 3.5% as a real interest return. So yeah, I think it still offers value, and the rand has maintained relatively good levels. I like rand a little bit stronger from these levels on, as we see dollar weakness feed through. So potentially opening up 663, 658 is the next technical level, and then obviously that big 655 is what we're all aiming for.
Okay, well, how likely, you're saying we're all aiming for that? I mean, 655, how likely is that in the next couple of weeks? Does it really all depend on the credit ratings agencies, what they'll be doing in the US and of course in Europe, or is it really about what we're seeing fundamentally occurring in South Africa?
Well, I think there's two things. I think that for now, the underlying fundamentals, obviously a lot of the PMI data will be written off to the fact that there were strikes. I think, you know, South African growth and obviously our deficit figures last week were pretty positive. So on a general keel, if you look at us as an emerging market, we still offer value, and I think from that perspective we can expect to continue to see foreign inflows into South Africa. What really worries me right now is the fact that it's really hot money moving into our bond market, moving into our equities, and it isn't necessarily that long-term FDI flow that we all want to see.
Well, given the fact that the Swiss franc is also taking a bit of a back foot when it comes to what we're seeing over the risk-on, risk-off trade, again, we're seeing this happening with a yellow metal as well, with gold. Do you think that it's all going to be about risky currencies, emerging market currencies going forward, and how are we going to be performing relative to our peers?
Well, I think what you're seeing on the Swiss franc and the Japanese yen they are basically our safe haven currencies for now. So those trades that we've seen go through overnight is really just on the back of what's happened in the US and the debt ceiling. The gold has been a similar scenario, but a lot of gold players seem to think that we're going to see some profit taking at these levels and even aiming up to $1,750. So that's quite significant in the bigger scheme of things. That being said, though, risk is back on. People are looking to put risky positions back on as we've got this debt ceiling issue behind us. But yes, you're right. It is around what the agencies say specifically to the outlook for the US.
Brigid, very quickly as well, I mean, looking at the unemployment scenario, we've got unemployment in the US sitting at 9.2%. We've got ISM numbers set to be released in the US today. If economic data really starts disappointing, can we expect the local currency to weaken as opposed to strengthening and heading towards that 655 as you're alluding to? Perhaps it could head closer to 680.
I think for now the dollar remains weak. We're going to see rand strength continue to come through. I think the South African economy unfortunately will feel the pain of what's happening globally, and so there is that significant risk in terms of our growth outlook, and I think that's why the Reserve Bank's opted to keep rates on hold.